What if one of the most important inventions in modern economic history was not a phone, a computer, or even the internet, but a simple steel box? It is so ordinary that most people walk past thousands of them every year without a second glance. Yet this one invention quietly reshaped how the world manufactures, finances, and prices nearly everything it sells. From a finance and business perspective, this is a story about cost curves. Before this box existed, shipping was slow, labor-intensive, and expensive enough that only high-value goods justified the risk of moving them long distances. Workers loaded cargo item by item into ships, trucks, and trains. Every crate of clothing, every machine part, every sack of food was handled separately, each one exposed to damage, theft, and delay. A single transatlantic shipment could take weeks to load and unload, and that labor cost was baked directly into the final price of the product. The world traded, but it traded slowly, narrowly, and expensively. Malcolm McLean and the economics of standardization. The shift began with a trucking entrepreneur named Malcolm McLean, who in 1956 loaded steel truck trailers directly onto a converted tanker ship rather than unloading their contents piece by piece. It looked like a modest logistics tweak. In financial terms, it was closer to a redesign of the entire cost structure of global trade. Economist Mark Levinson, whose book, The Box, remains the standard account of this shift, has documented how containerization cut loading costs so dramatically that shipping stopped being a bottleneck and became instead a source of competitive advantage for entire nations. The container itself is not the innovation. The innovation is standardization. Once countries agreed on a common box size, measured in 20-foot equivalent units, or TEUs, ports could redesign around massive gantry cranes that lift and stack boxes in seconds rather than hours. Ships were rebuilt as floating warehouses, capable of stacking thousands of identical units. Railways and trucking fleets were adjusted to match container dimensions, allowing a single sealed box to move from ship to train to truck without ever being opened along the way. This is what logistics professionals call intermodal transport, and from a financial standpoint, its real value is not speed alone but predictability. When a shipping company can calculate cost, time, and risk with precision, it can price contracts confidently, extend credit terms to distant partners, and plan capital investment years in advance. Predictability, far more than raw speed, is what lets capital move confidently across borders. The shipping giants, built on this idea, this predictability created an entirely new industry, and companies like Maersk, Mediterranean Shipping Company, CMA, CGM, and COSCO grew into some of the largest corporations in the world by owning and operating the fleets that make this system function. Maersk in particular, under the long stewardship of the Moller family in Denmark, built its business model less around any single shipment and more around scale itself, ordering ever larger vessels to push the cost per container down further with every generation of ship. This is a textbook example of what economists call economies of scale, where the fixed cost of a voyage is spread across so many identical boxes that the marginal cost of shipping one more unit becomes almost negligible. The fragility of this system also became visible to the public in 2021, when the container ship Ever Given, operated under a charter tied to the Evergreen Marine Corporation, became lodged sideways in the Suez Canal for 6 days. Billions of dollars in trade backed up behind a single vessel, and financial markets watched shipping insurance rates and freight prices spike almost overnight. That single incident was a reminder that the invisible efficiency of container shipping rests on an extremely thin, tightly optimized system, one where a single point of failure can ripple through global supply chains and corporate earnings reports for months afterward. Why this mattered to manufacturing and capital allocation. Once shipping became cheap and reliable, something changed in how executives thought about where to place a factory. Manufacturing no longer needed to sit near the customer. It could sit wherever labor, materials, or tax incentives were most favorable, with the finished product shipped affordably to wherever demand existed. This is the underlying mechanic behind the rise of global manufacturing hubs across parts of Asia over the past half-century, and it is why companies from Apple to Nike have built supply chains that stretch across a dozen countries before a single finished product ever reaches a store shelf. Executives at these companies did not choose those locations out of preference. They chose them because containerized shipping made the cost of distance nearly irrelevant compared to the cost of labor and materials. This is also, in large part, the answer to a question many consumers ask without realizing it. Why does a smartphone or a t-shirt cost so little relative to 50 years ago? Cheaper movement of goods translates directly into cheaper goods, because transportation cost is baked into the retail price at every stage of the supply chain. When that cost collapses, so does the final price on the shelf. A new global labor market was created. The container did not just move goods more cheaply. It created an entirely new global workforce, built around logistics itself, port operations, warehouse management, freight forwarding, customs brokerage, and supply chain software all grew into major employers, running continuously across every time zone. Companies like FedEx and UPS, which handle the last stretch of this journey, and technology firms building freight tracking software, all sit downstream of the same standardization that Malcolm McLean introduced. Even venture-backed logistics software companies today, including firms like Flexport, have built entire businesses simply on making container shipments easier to track, finance, and insure, which shows how much value now sits in the information layer wrapped around a physical steel box. Trust as a financial asset. Before containerization, ports were disorderly places where theft and breakage were common, and tracking a shipment was close to impossible. Standardized, sealed, numbered containers changed that by making every shipment trackable and accountable. In financial terms, this built trust into the system, and trust is one of the most valuable assets in global commerce. When banks and insurers can rely on predictable, trackable shipments, they extend trade financing more readily. When exporters trust that goods will arrive intact and on schedule, they take on larger contracts. This chain of trust is part of why global trade volumes grew so consistently in the decades following containerization, and why the World Trade Organization and international development economists often point to this invention as one of the quiet forces behind 20th century globalization, the invisible infrastructure behind e-commerce. This same infrastructure is also the reason modern e-commerce works at the scale it does. Amazon, Walmart, and countless smaller retailers depend on this container network to move inventory from factories overseas into regional warehouses before a single customer ever clicks buy. Without it, cross-border online shopping would be slow, costly, and limited to expensive niche goods, much as international trade was before the 1960s. With it, millions of packages move daily across oceans, countries, and cities, arriving at doorsteps in days rather than months, reshaping the idea of value itself. Before this system existed, most economies depended heavily on local production. A shirt might be designed, manufactured, packaged, and sold all in the same region. After containerization, a single product could be designed in one country, manufactured in another, packaged in a third, and sold in a fourth, with each step chosen purely for cost efficiency rather than geographic convenience. This changed how businesses and investors think about value creation. Value is no longer just about where something is produced. It is about how efficiently that product can move through a global network before it reaches a paying customer. There is also a financing dimension to this system that rarely gets discussed outside shipping circles. Containers themselves are frequently not owned by the shipping lines that use them, but leased from specialized container leasing companies, such as Triton International, which built an entire business model around owning fleets of steel boxes and renting them out much the way an aircraft leasing company rents jets to airlines that would rather not tie up capital in equipment. This is a subtle but important point about how modern global trade actually works. The physical box that carries a product across an ocean may itself be a financial asset, traded, depreciated, and leveraged on a balance sheet thousands of miles away from the goods sitting inside it. Investors who study infrastructure assets often point to container leasing as a useful, if unglamorous, example of a steady, recurring revenue business, similar in spirit to how real estate investment trusts collect rent on buildings rather than owning the businesses operating inside them. The next time a cargo ship appears on the horizon, stacked with thousands of identical steel boxes, it is worth remembering what that image actually represents. It is not simply cargo. It is a financial system encoded in steel, one that quietly determines prices, wages, and profit margins across nearly every industry on Earth. The biggest shifts in economic history are rarely loud or glamorous. Often they arrive as something as unremarkable as a metal box, one that changed the cost of moving nearly everything, and in doing so, quietly built the modern global economy.